Happy Friday, everybody. Today is August 29th, the last open market day of August. Markets open again on Tuesday after Labor Day. And remember, September has a record of being pretty weak, so we'll see how it plays out. So does August, but August didn't prove weak in markets. Anyway, today's episode starts with our first headline: Alibaba enters the semiconductor space. Headline from CNBC.com today: Alibaba is developing a new AI chip. Add to this, one of the smaller semi-chip American makers, Marvell, did not have such great earnings after the close yesterday, dropping by 19% today. We also had Nvidia finally dropping 3% today. Remember, the earnings came out Wednesday after the close, and we didn't sell off until today. So it probably had something to do with the Alibaba news and the Marvell technology news. I noted yesterday how interesting the semiconductor ETF SMH went up while Nvidia went down a little bit. And it looks like today the market woke up to the fact that I've been suggesting on this show for a while. At the end of the day, do you really care what brand of chip you have in your computer, or do you just want one that works? Competition is going to make profit margins get squeezed. And with the amount of growth priced into companies like Nvidia and the enormous size of it, the fall is going to be way bigger, in my opinion, than most people can actually even imagine. Can people buy the dip and send semiconductor stocks higher and higher? Yeah, they can. I know I'm not going to be a part of that game of musical chairs. Next headline: PCE as expected. Actually, exactly as expected across the board in both headline month over month, year over year, and core month over month and year over year, with the core staying hot at 2.9%. We also had personal income and personal savings come out quite strong at 0.4 and 0.5% respectively. But the part of the report that is often ignored, that has been really bothering me, and I think is really the most important one right now for where we are, is the personal savings rate dropping from last month's reading to from 4.5 down to the July reading of 4.4. Remember, below 5% as a personal savings rate, it only happened, basically 1999 and going straight into the dot-com bust, and also 2005 going straight into the great financial crisis. Outside of those periods, we've never seen the personal savings rate, how much people are saving, this low, below 5. Below 5 is not a good number. And we've been basically bumping along below 5 since the beginning of 2022 at this point. Next up, community topics. We're going to change it up back to what moves did you make today, if any. Comment below. Robschild got stopped out of a gold short, lost some money. Yes, I still believe gold is in a bubble, and it'd be nice to make money when it pops, and gold can go higher because I don't control what other people do with their money. I've decided to close it over the 3-day weekend, because when you take the previous two highest points to make the highest possible trend line, we are clearly highly broken out of that. To my eye, we're clearly easily headed up to the $3,500 level at this point. So I got stopped out of my short. What about you? Did you make any moves today? Comment below. Coming up next week, we have very, very important data starting on Wednesday with job openings, and we have Friday the unemployment report. These are the two biggest economic data things coming out next week. We also have some other things, ADP, ISM, and a few other things, but these are the real main ones, Wednesday and Friday. Also, of course, as always, tariff updates. Thank you so much for watching, liking, subscribing to the channel. The subscription button it's right there. You put your mouse over it, you click subscribe if you want to keep up with me and my videos. Commenting, all your comments are awesome. I love all of the interaction on the community, and supporting Robschild. Special thanks to those of you who have been supporting me via PayPal. Many of you have been very, very generous. Your support helps the channel. Read my website in the description to go through the daily reminders, macro views, and Robschild portfolio, and no changes in the crystal ball ratings. I'm hoping to really polish up the portfolio page this weekend. On to the charts, starting with SPX, the S&P 500 dropping by 0.64% today. It's been funny to, over yesterday and today see the advanced decline line do play opposite game. When the S&P 500 goes up, the advanced decline line went down yesterday, and today it was the opposite, with the S&P 500 dropping. The advanced decline line actually rose. So it was the bigger names that sort of pulled the market down today. I wanted to mention the VIX rose to 1535, but still very much below 20. The pricing of options does not have very much fear. Not yet. The 10-year Treasury note yield essentially went flat today. It rose by 2 basis points. I wanted to go over once again, haven't talked about this for a while, a larger structure in the 10-year Treasury note yield. And sorry if it's hard to see because of all the crazy lines on the chart here, but I'm talking about this purple line here, which is to me a pretty clear head and shoulders at this point, which looks like it may be starting to play out. And if it were to play out, the 10-year, if it were to play out like it would normally play out as a chart pattern, we could expect the 10-year Treasury note yield to drop as much as to 2.5% basically, which would be pretty extreme, and it's not going to get there unless the markets are really collapsing. Main point, I just wanted everybody to be aware of this situation. The neckline, if we get there into the near future, will be around 3.9. So if we get below that, this thing by this chart pattern could really be a sign that yields are going to be dropping much further. Next, Bitcoin. I am still short Bitcoin, dropping by 3.8% today as of the recording of this video. There's not a ton of support at this level. I'm expecting it, along with many other traders that I follow, to drop down to the $100,000 level sooner than later at this point. I also think it's worth mentioning the divergence between the performance of Bitcoin's price and the price of gold today, with gold going up quite a bit with a quite good sized candle up not 0.9%, while Bitcoin on the same day dropping by 3.8%. A lot of people have been wondering, is Bitcoin the new gold? Is it going to function as a inflation hedge, risk off kind of a entity? And today proved that money is not always going to be running to Bitcoin at the same time as it's going to be running to gold. At this point, to me, they're both acting as highly speculative, bubbly territory kinds of things that can both collapse greatly, but the divergence right here is fairly notable, I think. Next, the dollar index, sitting on this gray line that I've had here at 97.85, just touching it exactly today, sitting over it. Granted, we are sort of hammering on it, right? 1, 2, 3 times. So maybe this is a knock on this line to go lower or not. I've been saying I think the dollar may be actually building a base here, that there's too much fear of the dollar. Every time I hear somebody talk about the dollar, I don't hear anyone having very much confidence in the dollar. I think there's too much fear of the dollar, and I think that's actually going to give it more strength than people think, if not completely fundamentally, from a psychological standpoint, with too many people being on the wrong side, one side of the ship, and having the other side of the ship rise because of it. The price of copper rose almost 1%, about 4 cents today. Are we going higher and higher on copper? I don't think we can count this as a breakout yet. So still in nothing to see here, folks. Move along mode. Some interesting developments in the energy sector. Crude oil still going completely sideways. However, the ETF, the energy ETF XLE, I pointed out the other day, I'm seeing sort of this cup and handle pattern. These were circles circling the volume spikes on the sides of the cup, which is really typical of a cup and handle, breaking higher and then continuing today momentum higher. Just to remind everybody, XLE, this ETF, when it's going up and other things are going down, that can lead into more weakness. Next up, junk bond spreads. Again, this updates in the morning for the day after, and I talked about on the show how we were going into tighter mode, and we did this morning, dropped down to 2.75, but today HYG divided by SHI actually dropped, so credit spreads widened a little bit back today, gave some of that back, a little bit of that back today. Sorry I didn't have the symbol on there. Again, HYG divided by SHI, it can give you a more current look at where credit spreads are going. So not falling off the face of the planet, but widening a little today. We hit a new record low in the S&P 500 dividend yield specifically today at 1.18%. This might be updated a day behind. Yeah, it is August 28th. But once again, I need to reiterate, we have not seen the dividend yield of the S&P 500 this low since the dot-com bust, and never before that, ever in history. Can you imagine how cheap stocks would have to get if people like me and, well, let's say if I had an army of people join me and say, no, we actually want our dividends from our stocks. We don't believe you companies are, being the smartest with this money. We want to decide if we're going to buy more of your stock or not just have you just keep it as part of the company or buy back shares, especially when it's inappropriate. I mean, one of the things that drives me crazy is when I'm seeing companies that are supposedly well managed that are buying back their own stock when the stock's not even cheap. That's a huge waste of money. That is a misallocation of funds. It helps the CEO. It helps some entities with tax things going on, and I understand that, but that's, in my book, very bad management. Buybacks are only appropriate when a stock is obviously too cheap. That's a good use of the money that the company is making. Moving on, I wanted to mention the put-call ratio, not abnormally high. Not a whole lot of hedging against downside, which in my opinion can be an indicator that the market is allowed to fall further. I am a little surprised the put to call ratio isn't a little higher, especially going straight into December. Sorry, not December, September. If the market collapses, not many people are going to benefit from that in terms of put holders, and the call holders will get hurt worse. I meant to put this at the beginning of the show, but I might as well talk about it now. The U.S. Chicago Purchasing Managers Index, the PMIs, came out much lower than the forecast, of which was already low. Remember, anything under 50 is not good. It's contracting in the manufacturing sector, and we've been below 50 for about 2 years at this point. This is not a good sign. It might be a little hard to see, or you might want to go check this chart out yourself on investing.com. But in good times, we're typically, at least above 50 most of the time, occasionally dipping below 50 into contraction mode. We never stay below 50 unless we're literally in some kind of crisis, like the dot-com bust, like the Great Financial Crisis, like the 1990 recession, like the 1980 recession, like the 1974, I think the 76 recession. I have a lot of warning signs on my website, and this isn't even on them. It's just another piece of the puzzle saying that, yeah, we're headed into something pretty bad. Next up, 5-year and 10-year break-even inflation rates ticking down slightly today. Looking like we're sort of forming some kind of flag thing, basically going sideways here. One way to look at it is lower highs on the top and higher lows, so a bit of contraction. Lastly, the chart that I'm maybe most famous for, it's the most watched, viewed on my channel when I titled talking about this, the 10-year minus 3 month. Of course, exactly at 0 going into the Labor Day weekend. Is this the end of this contracting wedge after a record long inversion of the yield curve, the 10-year yielding more than the 3-month for such a long time? I mean, this is just so epic. It's epic. It's absolutely epic. I know everyone watching this has probably heard me say this 1,000 times, but when you dip below 0, it means the Fed's strangling the economy, and once they're done, we go into a recession every single time. And since 2022, October 2022, we went into the deepest, longest inversion of basically all of history, and now we're winding up around 0, just tighter and tighter. I think this is the end, and I think stocks and risk assets are about to fall way more and way harder and way faster than anyone out there can actually possibly imagine. But remember, guys, I'm just a guy with a crystal ball, and that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.